Jamie Dimon just said that Wall Street is too hopeful that our economy is going to avoid a recession and see a soft landing. Jamie Dimon, for those of you who don't know, is a CEO of the largest bank in the United States, JP Morgan Chase Bank, and just recently he did an interview with CNBC where he said that he thinks investors are too hopeful about our economy in the United States and that investors are too hopeful for a soft landing in the United States.
The market is kind of pricing a soft landing. That may very well happen, but the odds at 70 or 80%, I would give them half of that. That's all.
Now, just so we're on the same page, a soft landing economically comes from this idea of a soft plane landing, where if you've ever ridden a plane before, the plane lands very softly and you don't get this abrupt shock when you hit the ground. A soft landing in the economy is when you see three things happen. Number one is where you see inflation fall, because number two, you're working to raise interest rates. And while all that's happening, you have number three, a strong economy, a strong GDP, where you don't see a huge run up in unemployment. This is considered a soft landing because, as you know, we've been facing this high inflation for a number of years now. And in order to fight this high inflation, the Federal Reserve Bank has been working to raise interest rates to cool inflation, to bring inflation down. And the goal is to not see this major change in our economic growth and not see this huge run up in unemployment. This would be a soft landing, and this is what Jamie Dimon says. A lot of people on Wall Street are hoping for this type of soft landing, but he's not as optimistic or hopeful for this soft landing. He says that we have a bigger chance for a recession than what many investors are hoping for on Wall Street, because what he said is that investors are pricing in a 70 to 80% chance of a soft landing, where Jamie Dimon says he thinks is closer to half that. By the way, if you want to watch the full interview by Jamie Dimon, I got the link for you down in the description. But if I'm being completely honest, the part of this interview that was really interesting to me, besides the soft landing versus recession talk, because, well, a lot of people have been talking about this, is why Jamie Dimon says that our economy is doing so strong. In this interview, Jamie Dimon says that the secret sauce for our economy, the reason why our economy is doing so strong, isn't because businesses are producing such good products. It isn't because the consumer is spending so much money. It isn't because consumers are going into credit card debt and spending money. It's because our government is spending so much money. Take a listen.
And why are we doing so well? A lot of it's fiscal spending.
Remember, our economic system runs on spending. If you go out and you earn $100 and then you take this $100 and you put it in your pocket, well, that's not stimulating the economy. That doesn't really do much good for the economy. It's good for your wallet, maybe it's good for your investments, maybe it's good for your savings, but it's not good for the economic system. But now if you take this $100 back out of your pocket and now you go to Chipotle with this $100 and you buy yourself a few bowls of Chipotle and then you get some extra guac, well, now this $100 is being spent in our economic system. Now Chipotle is making money, the investors at Chipotle are making money, and now this money is being used in our system. But when it's sitting in your pocket, it's not doing much. So our system runs on spending. The more money you spend, the more money somebody else makes. And one of the biggest spenders in our economic system is, well, our government. Now, my team at Briefs Media did a full deep dive of this in Market Briefs. Market Briefs is our free financial newsletter where every day my team is breaking down what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you want to stay up to date on what's happening in the markets, Market Briefs is a free and easy to use tool that we created. And if you want to join Market Briefs, I got the link to how you can join down in the description below, or you can go to briefs.co/market. That's briefs.co/market. But if you take a look at government spending in 2023, what you'll see is that in 2023, the United States government generated $4.44 trillion in taxes. But then they went on to spend $6.13 trillion in taxes, which meant they spent $1.69 trillion that they didn't have. Now, let's really think about this in terms of how our economic system works. Our government is a spender in our economic system, because when the government goes out and they build bridges, they're paying people, they're paying construction companies, they're paying for the asphalt, they're paying for the cement, they're paying for the paint, they're paying for the equipment. When they go out and they hire police officers, they're paying people, they're paying cars, they're paying for uniforms. So they're paying for things in our economic system. So when the government spends more money, that's good in the economy, especially in the short term. But what you have to remember is the government has to get this money from somewhere, right? We know where this $4.44 trillion came from. This came from taxes. And the government has one source of income, tax dollars from taxpayers. So when you go to work or I go to work and we get paid, some of our money automatically goes to the government in the form of taxes. When you go and make money in your business, well, some of the money is going to go to the government in taxes. When you make money from your investments, some of the money is going to go to the government in taxes. So we know where these tax dollars come from. So when the government goes out and spends these tax dollars, you and I might not agree with how the government is spending these tax dollars, but we know where that money is coming from. But it gets a little bit more interesting when the government goes out and they spend money that they don't have. Because now if the government is spending money they don't have, how do they actually get that money? Well, if they don't get that money from taxes, then it gets a little bit confusing, because one thing the government can do is if they want to go out and build a bridge with money they don't have, they can go to Congress and they can say, hey, we want to go out and raise $1 trillion to do X, Y, and Z. We want to build a bridge. We want to build a new thing. And if they can approve a new tax, you know exactly where that money is coming from. But if it's not coming from taxes, then the person who's paying the price is everybody, especially the person who doesn't understand who is paying that bill. Because when the government now is spending this $1.69 trillion that they don't have, that's good for the economy in the short term, because now, well, that means the government is hiring people, so people are getting jobs. And that means the government is paying companies, which means these companies are generating revenue, and contractors who are working for the government are getting paid. So when the government spends money in the short term, that's good, because that means people are making money, but there's a price to this. One of the things that I'd like to say is that the most expensive kind of money is free money, because when the government has to go out and spend this money, that means they have to finance this spending. Now, if you think about this in terms of your own personal finances, if you go to the Gucci store and you spend $1,000 that you don't have, well, what's going to happen? You're going to have to pay that $1,000 back plus interest. And some interest is more expensive than others. If you go and put it on your credit card, well, now you have to pay 25% interest if you don't have that money sitting in your bank account. If you go and you refinance your home and then you use this cash out refinance to pay for that Gucci, now that's going to cost you, I don't know, 5, 6, 7, 8%, depending on what type of loan you can get on your cash out refinance. I do not recommend you do this, but you have to understand that there's different ways to finance this. For the government, it works the same way. There's different types of loans that the government can take out. Now, the government can borrow money from people like you and me, or they can also borrow money from the Federal Reserve Bank. The Federal Reserve Bank is the central bank in the United States. And if you remember what I talked about in the beginning of this video, when we were talking about a soft landing, we saw that interest rates were going up to bring inflation down, and a soft landing is when you have the economy that stays strong. Well, the entity that's in charge of those interest rates is the Federal Reserve Bank. They're the central bank in the United States. And the interesting thing about the Federal Reserve Bank is that although they're called the Federal Reserve Bank, they're not federal, they're not part of the government, and they're not a reserve. They're not sitting on cash reserves. They're not sitting on a cash pile, and they're not a bank. You and I can't go there to deposit money. So now the Federal Reserve Bank has the ability to influence interest rates, and they also have the ability to print money. So now when the government wants to spend $1.69 trillion that they don't have, then the Federal Reserve Bank can print this money out of thin air and then lend it to the United States government, which means now the government has money that they can spend to build a bridge, to hire people, to do whatever else that they want to do, which creates that boost of the economy in the short term, because that creates more spending. That's an additional $1.69 trillion worth of spending in our economic system. Remember, if I keep $100 in my pocket, that doesn't do anything for the economy. If I spend $100, that boosts the economy. If I go into debt to spend money, that boosts the economy even more. But when the government is now going into debt, spending money that's created out of thin air, that's boosting the economy even more. But there is a consequence to this. What that ends up doing is it devalues the currency. The value of each individual dollar goes down, causing the price of things to go up. And when the price of things go up, that disproportionately hurts some people more than others, because, well, when your rent gets more expensive and your groceries get more expensive, that hurts some people more than others. And some people benefit from inflation, because when you see inflation, your asset values also benefit, and the people that own assets aren't just the rich and wealthy, it's the people that are financially educated. And this is why you have to understand now how this impacts the economy, because this government spending is creating a boost to the economy, especially in the short term, but there's also the inflationary consequences, which the Federal Reserve Bank is working to fight on one hand. So on one hand, the Federal Reserve Bank is working to raise interest rates to fight inflation. On the second hand, the Federal Reserve Bank is printing money to fund the government spending, which is causing inflation. So you can start to see the kind of issues here, and this is one of the reasons why Jamie Dimon says our economy is doing so good right now, is because the government has been kind of buoying and supporting and stimulating this spending, which is keeping our economy strong. And a third point that I want to highlight here is risks to the real estate market, because we know that right now our commercial real estate market is going through a change. The first change is that, well, a lot of offices are still sitting vacant because some companies went bankrupt, some companies are completely remote, some companies are hybrid. So you have a lot of offices that are sitting partially vacant now. And many of these office landlords are not making as much money as they were before the pandemic because of that. Well, the second thing that's happening right now is a lot of office loans are starting to come due. 2024 is the first year of this kind of tidal wave of loans readjusting in the office market. We'll see more loans readjust in 2025, which means now, if you are an office landlord and you're sitting on a property worth $10 million, $100 million, $1 billion, well, if that property is 50% vacant, you're not making as much money as you would like. And if now your interest rates readjust on your debt, well, that means your costs are probably going to go up a lot because interest rates are a whole lot higher today than what they were a few years ago. So now if you're an office landlord and your interest rates start to readjust at a time where your revenues are not very high, you can start to see why that's a problem. And this is what Jamie Dimon talks about. Take a listen.
If rates go up and we have a recession, there will be real estate problems. And some banks will have a much bigger real estate problem than others.
Now, one caveat that I want to give you on this is that while this is a concern, especially to the office real estate market, what Jamie Dimon says is that the size of this concern, this office real estate concern, is significantly smaller than the real estate market meltdown that we saw before the 2008 crash. So just something for you to be aware of, but understanding that there are risks in the economy and that these risks don't happen overnight. These risks take months and sometimes years to really build up, and also understanding that no market goes straight up forever. We have risks in our economy, inflation is still there, we have interest rates that are still high, and we don't know when interest rates are going to get cut, but understanding that, you know what, there could be impacts of this. And the people that can benefit if impacts happen are the people that are financially educated and the people that are prepared. So what you should be doing is understanding, not worrying, not panicking, but understanding how you can be financially educated and how you can be prepared. Being financially educated means learning about money, learning how to invest, learning different ways to invest, building a financial system, and then preparing means putting cash aside. Not just to protect you against an emergency, but to protect you to be able to capitalize on opportunities that might come your way. Because if you see a market opportunity, if you see a stock market crash, if you see a real estate investment opportunity, if you see a business opportunity, the only way you can capitalize on it is if you have some money to actually go out and capitalize on it, and you have the education. And that means this is the time where you want to make sure you're investing in your financial education, but also making sure you're ready to be able to capitalize on opportunities because, well, if things go down, you want to make sure that you can be in a position to capitalize on those opportunities.
If you look at that 100% of debt to GDP, I think 1935 it's going to be 130%, and it's a hockey stick. So that hockey stick doesn't start yet. We kind of got time, but when it starts, markets around the world, by the way, because foreigners own $7 trillion of U.S. government debt, there will be a rebellion.